Hi, you're watching Stephan Livera podcast, brought to you by swan.com. Today we're talking about Bitcoin self-custodial finance using DLCs with Philipp Hoenisch from 1010.1. So what are we getting at here? This idea is people are able to use DLCs, discrete log contracts, to set up self-custodial finance. And so this is for people who are interested in things like trading or potentially having some kind of synthetic stable value. Now, I'm personally not a trader. As many of you know, I'm more about hodling and stacking and not your keys, not your coins. But actually, this is an interesting application for people who are interested in the trading aspect of it, or potentially the stable value aspect, which might be interesting for businesses and also individuals, certain individuals. So I think there's some interesting applications here, and I think you might find this conversation interesting with Philipp. Philipp, welcome to the show.
Hey, Stefan. Thanks for having me.
So, Philipp, I know you're building and you're the founder of this app, which I think the first thing is people get confused about how to pronounce it, right? It's 10.10.1, but it actually looks like 10101. So, well, again, let's start there. Why the name 10.10.1?
10.10.1. It's quite a nerdy name, actually. It's binary. It's 1010101, which is the binary representation of 21. And we all know 21 as in 21 million Bitcoin. We picked that name because it's our philosophy. It's in our blood.
Great. Awesome. And let's hear a little bit about yourself in terms of how you got into Bitcoin and why you're starting, why you're working on this particular app.
Sure. About myself. So I got a software engineering background and I studied software engineering master, and later on I did a PhD as well. But in around 2012, I got an email from my brother with the subject, the future, and in the body was just one line, and it was the link to the Bitcoin wiki. It was like the article was about autonomous agents paying each other with a new digital currency. And I was studying distributed system technologies back then, and I was like thinking, this is pretty cool. Distributed agents paying each other for tasks. This sounds really cool. What is this thing? Well, I got into Bitcoin and then I lost everything in 2014, which branded me a bit. It marked me. And actually I lost track of Bitcoin for a few years because I thought it's a gigantic scam. I mean, it has this promise of self-custody, but if you want to trade, you have to trust someone else. You have to deposit your hard-earned monies in someone else's wallet and just hope that at the end of the day you get it back. And I thought it's not holding up the promise. I didn't do my research, obviously. It was my own fault. But in 2017, I got back. And in 2018, I started a company with the focus on removing counterparty risk for trading.
Okay, so that was 10.10.1. You started in 2018. Or that was another company?
It was another company. It's actually Coblox. We started as a research lab. And we did research in the cross-chain space. So we did cross-chain atomic swaps between, I think we were the first one, or allegedly the first one, doing Ethereum to Bitcoin and ERC20 to Lightning. And later on, we did like Grin to Bitcoin and Monero to Bitcoin. But all of this, it was just a research product. It was not a user-facing product. Funnily, our Monero Bitcoin atomic swap POC, let's call it POC, was picked up by Samurai Wallet, and they integrated in their wallet now. So it's still alive after we left it to the community over 2 years ago.
And then, so when did 10.10.1 start?
Yeah, so we had the problem that most Bitcoiners don't want to leave their safe haven. They don't want to trade from one coin into another. They just want to increase their Bitcoin stack and reduce the amount of time they hold any other asset. And around that time, I learned about derivatives trading and BitMEX and found that this is actually pretty cool. You should build derivatives trading on Bitcoin. And since we learned about adaptive signatures and more complex cryptographic protocols through our cross-chain atomic swaps, we came across DLCs and thought, hey, cool, with DLCs, we can build derivatives trading on Bitcoin without counterparty risk. And that, I think we started like 2.5 years ago with Itchy Sats. So our first product was Itchy Sats, which was this application you had to download for your Umbrel, your Raspberry Blitz, your Cloud9. So for the self-sovereign Bitcoiners, but it was an application you had to run 24/7. And it never really took off that much because it's a very niche, like running on Umbra, running on Raspberry Pi. So I think it was just before Christmas 2 years ago. 2 years ago, we joined the Legends of Lightning Hackathon, which is this online tournament where we said, you know what? We're going to give it 8 weeks time to pivot from our custom layer 2 protocol where you could trade perpetual futures to trade it on Lightning. And we wrote it. We managed to pivot within 8 weeks. We had a POC running at the end of those 8 weeks, and we realized people love it. They want to trade on the phone. They want to use Lightning. And that's when we pivoted and rebranded as 10.10.1 and started everything from scratch.
I see. So as I'm understanding then, the idea here is you want to create this non-custodial trading vision. I guess that's, broadly speaking, that's what you're trying to achieve here. And that's where, DLC stuff, obviously DLC stuff has been around for a few years. So for listeners who aren't familiar, DLC stands for discrete log contract. I believe it was invented, or at least researched early, was done by Taj Dryja, who was also one of the authors of the Lightning white paper. So funnily enough, he's had impact in a bunch of places. And I have some earlier episodes for listeners with Chris Stewart from Shortbits, although I believe Shortbits is no longer operating, sadly. And I did an episode with Nadav Cohen, and Ben Carmen used to be there as well. And I also, so listeners might also be interested, I have an earlier episode with Matt Black from Atomic Finance as well, also working on DLCs. But everyone's got their different vision of what they're working on. So do you want to just give us a little bit from your perspective, just set the background for people? What are some of the basics of DLCs that we need to understand before we can sort of go further on this conversation?
Maybe we even take one step back. What is the problem we try to solve? And the problem we try to solve is remove counterparty risk from trading, because FTX is still in everyone's mind. Mt. Gox is a bit longer ago, but there were several other exchange hacks in the past, and counterparty risk is a real problem in trading. And in the altcoin world, they have more complex smart contracts with solidity and all kind of stuff where they can remove the counterparty risk and then trade directly with each other. On Bitcoin, we don't have such a powerful scripting language. So we had to come up with something smarter, something cool. And Tej came up with DLCs, discrete log contracts, which is a way to have smart contracts on Bitcoin, but without having to put all the data of the contracts on chain. So the contracts are discrete in a way that only the two parties who are transacting in this contract know about it. And in a very simple, in a nutshell, broken down, the way how it works is, let's say you and me, we want to transact on a coin flip or any kind of smart contract. We lock up money in a multi-sig, which is a 2 out of 2 multi-sig. And then from that multi-sig, we generate output transactions, actually CETs, contract execution transactions. And one CET represents one possible outcome. So if you do a coin flip, there are 2 possible outcomes. And then we need an independent third party, an oracle, and the oracle attests to the outcome. And then if the oracle says, okay, heads up, then it signs, it attests to that, it creates a signature, and with this signature, one of the CETs becomes valid, and we can publish that CET unilateral on-chain and get our money. So CETs are a way to have smart contracts on-chain, but without the footprint. So on-chain footprint is just a 2 out of 2 multi-sig.
Gotcha. Yeah. So I think for listeners familiar with Lightning, there's some similarities there. It's kind of like if you think from a Lightning context, my channel open or funding transaction, right? We're sort of creating this 2 of 2 multi-sig, and then we sort of keep this off-chain closure transaction, and that's like the commitment transaction in Lightning. And this, in the DLC context, it's a contract execution transaction, as you said. So it's kind of like we create this 2 of 2 multi-sig, and we sort of pre-sign all of these states, sort of like channel states, and depending on what the oracle does, it will make one of those states valid when we actually go to close it. Is that sort of high level what's going on, or roughly?
Yeah, exactly. The one important thing to emphasize though is that the oracle is also not aware of our bet. So if we take a bet on the Bitcoin price, we take an oracle which just stupidly attests to the Bitcoin price every minute, every second, every hour or whatever. And it doesn't even know that we exist. We just go to their website and grab the signature from this website. And then we know what to do with this. But the oracle is completely independent of this.
Right, yeah, because that's also to take away some of the risk of the oracle trying to bias towards me or to you to sort of help us win the bet in that case. And I recall that in some of the earlier years of DLC, people were talking about it in this sense of like, doing a bet with somebody, like, is Trump going to win or is Biden going to win or something like that, right? Now, what we're also starting to see is more like not just kind of like a binary, is this person winning or losing, but more like there are, let's say, different gradations or different possible states. And I guess that's where you're getting into this idea of non-custodial trading. So do you want to explain a little bit about the differences there?
So there are two different ways of possible outcomes in the DLC space. The first one would be talk about the concrete outcomes, where you have did Biden win? Yes or no? Is it going to rain? Yes or no? These very simple questions, but the more complex one are the numerical outcomes, and then you have a certain payout curve. For example, if we want to bet on the Bitcoin price, we don't say, is the price tomorrow above, it's 70K? No, we're going to say, like, if the price is tomorrow at 70K, then you get this amount, and I get this amount. If the price is at 71, you get this amount, and I get this amount. If it's at 59, you get this and that. So you need to really plot every possible price on this curve and then create a CET. Now, the problem here is, or the challenge here is that you are generating hundreds or even thousands of possible transactions. Let's say, again, the Bitcoin price. In the naive way, we would need to plot every possible price from 0 to 100K or 200K or whatever. And depending on how long your contract is, you can do more educated guesses and then reduce the amount of CETs. For example, if you do a 24-hour bet, I guess it's very likely to say the price won't go above 150K and it won't go to 0 neither, or it won't go to 20K. So we just can cut this off and we can say everything below this price, you get everything, and everything above this price, I get everything. And then in between, we have one possible outcome for each, one possible CET for each possible outcome.
Let's walk through the app as well. Now, I had a chance to just kind of play around as well, but just for the benefit of the listeners, can you just walk through what does it look like when people are trying to play around with the app? And I guess just while we're here, I just want to make it clear, I'm sort of interested in discussing mainly from like the technical perspective and also just sort of what does it mean having non-custodial trading. I'm not necessarily saying people should go out and trade, to be clear. I'm saying, stack and hodl. I'm not really a trader myself, but just for the sake of understanding how the app works, can you explain how does it work there?
I'm totally with you. I don't want to bring people to trading. I don't want to say, hey guys, gamble your life savings. I want to make it safer for people who are trading already. That's the important thing. So our app is a trading app. So people can trade peer to peer. And the way how it works is it is a wallet. So it's an on-chain wallet. It's a self-custodial on-chain wallet, and you deposit money into this wallet. You get your 12 seed words, and with those seed words, you can always recover your money. And what's happening is when you trade for the very first time, you lock up money, parts of this on-chain balance, into a channel. So we took actually the concept of the on-chain, the vanilla DLCs from Taj, invented in 2017, and built something we call DLC channels. And that allows us to then later on settle trades off-chain for free. But for that, to that a little bit later probably. So when you onboard, you deposit money, and then you open up your first trade and you select the channel size. And right now, the way how it works is that you and 1010 are funding that on-chain, that funding transaction. So we both put in money and then we have it off-chain. And from there on, we create our DLCs. If we want to settle our DLC, then one CET will become valid, but we don't go on-chain and spend on-chain transaction fee. No, we settle into the channel so that you can open up another trade basically for free. And there's an it's a technical and a financial reason why you have a direct channel with us. Most listeners will think, oh, so you're always the counterpart of the trade, but we are just the direct partner of each trade, but we forward the trade to someone else. Meaning we have another channel open with a market maker. Someone is constantly offering trades of orders to you, and they trade through us and to you. Meaning if you go long, we go short against you, and then we go long against the other party. And the cool thing about this setup, so we call this guy the coordinator, is that we removed the free option problem. And the free option problem in DLCs is that the party who signs last has the possibility to hold back the signature and wait how the price evolves. And with our setup, what we do is we just wait for both parties to sign, because we are in the middle, and then we hand over the final transactions to each party, and then they trade against each other.
And so as an example, let's say the user is depositing some Bitcoin into his 10-10-1 app. It starts in the on-chain component of it, and then you have to actually open a channel, or you start a trade, and that in that process, you're opening your first, let's call it DLC channel. I think that's the term you use. And so then at that point, the user has the choice of, okay, what price or how much in USD, as an example, are you going long or going short? What level of margin? And you can see things like what's your liquidation point and so on. And so then let's say the user, just to make an example simple, let's say, 500,000 sats, they're going long at 2x leverage. They can see the liquidation price, etc. And then it enters into the trade, right? Like, can you just walk us through what's going on there?
Yeah, sure. So as you said, you first see what you want to put in there. Right now, the input has to happen in US dollar terms, so the amount of contracts you want to go long. And this is a perpetual future. And a perpetual future is meant to not have an expiry. Now, we cannot have DLCs without expiry. We need to have an expiry. And our DLCs always expire on Sunday at 1500 CETs. That's when I forgot the index. There's an index which is always announced at 1500. Anyway, so you say you want to go 100 contracts, which equals $100 worth of Bitcoin long. You pick your leverage. If you say leverage of 2, then it calculates how much margin you have to put up. And if you click confirm, what happens is you send a market order. So right now in the app, we only support market orders, no limit orders, to the order book. And the order book is trying to find you a match, because behind 10-10-1, there might be multiple makers. And we try to find you the best of all of them, meaning the best price for you. And then we connect you with the other guy together. The cryptographic protocol is executed. The CETs are being created. And when everything is done, you have your open position.
And so then at that point, you're sort of monitoring your position, and you can sort of see, okay, this is how much you're in profit or loss, whatever. And so crucially, that's also where you get your fee, right? Like 10-10-1 is taking a fee at that point.
Yeah. So we call it a maker-taker fee, just same as on every exchange. We charge a percentage-based fee for every executed trade.
And so then when it comes to closing down, that's where you are winning back an amount in Bitcoin terms, right? Because that's really, there's no USD here. It is all synthetic, and it is just Bitcoin here. So that's where the CET is, I guess, because in this case, we're talking about a DLC channel, right? It's not actually an on-chain DLC. So can you just walk us through what's happening there?
Yeah, exactly. So maybe to finish what I started earlier, I didn't say, but it's, we want to represent perpetual futures which don't have expiries. But since DLCs have expiries, what we do is we roll over your position automatically if you come online on between Friday 1500 and Sunday 1500.
Okay, so you've got like a 2-day window to come online to kind of refresh it if you want to.
Exactly, yeah. And then your position automatically extends for another week. But in between, you can close your position not unilateral, but you can close your position collaboratively into the channel with us at any point of time. Now, the interesting thing is, most people now think, okay, what if you're in profit, but the other party is not in profit? Obviously, right? You go long, the other party goes short. So he has no incentive to close his position right now. Why would he collaborate closing the position with you? Meaning if you decide to close your position, what happens is you again have to send an order to the order book and find someone else basically taking over your trade. So you're selling your position to someone else. And that allows us to have, for one party, long running positions, while for someone else, they can do short running day trading or 100x, not yet 100x, but very short running trades.
I see.
So your question was, what happens? Same as on Lightning, we take an optimistic approach of settling in the channel. So on Lightning, when you do a payment, you have an HTOC attached. And then at the end of the day, when you receive the payment, you say, hey, look, I know the secret. I could go on chain now and execute that contract and get the money out of the HTOC on chain. Or we save transaction fees and we just settle into the channel, meaning we update commitment transactions, which then reflects the new amounts. And the same thing is what we do. We say, look, the Oracle says the price is at 60K. I could go on chain now and get the money, but that's going to be very costly. So what we do is we settle off chain into our DLC channel. And just until a month ago, end of January, we actually had Lightning channels. So it used to be Lightning channels. And then you could send out the money over Lightning. Now it's just vanilla DLC channels and they are not connected to the Lightning network yet.
One other question just around expiry. You mentioned this earlier that, if you come back online within that 2-day window, and is it like an action you have to take to refresh it or to stay in that? Or is it more like you are just it's more like an opt-out system?
It is an opt-out system. So if you come online in this window, we actually even send you a push notification and say, hey, the rollover window is open now. And if you come online, it automatically extends for another week.
And so at that point, do you have to pay another round of fees at that point, or how does that work?
So right now there's no fee involved, but eventually we're going to have something called a funding rate, which probably listeners know.
Yeah,
from
that's actually what that was going to be my question. Like on the centralized exchanges where people are, custodial, they're paying a funding rate, and at a certain time period, as I understand, it's they're paying a certain rate, whatever that rate is, and that actually depends on like what's the balance of shorts and longs and things like that. I don't know the details of it. I'm not going to pretend to explain that part, but my understanding is there'll be times where the longs are paying the shorts, etc. Right, and that's kind of, I think that's typical actually. But anyway, the point is there's a funding rate on the exchanges, and you obviously have to reflect that somehow, some way. So how does that work? Or how will that work in a 10-10-1 context?
Yeah, totally. So the idea of the funding rate is actually to ensure that the prices of the derivatives do not diverge too much from the spot price. And on centralized exchanges like BitMEX, they have an index price, which is a basket of different spot exchanges weighted according, I think, their volume or something. And if the funding rate is positive, it usually means that the market is more bullish, and people, if the funding rate is positive,
a lot of people want to go long, and so that's why the longs are paying the shorts, right? Yeah.
Exactly, and then the long paying the short. And if you look at historical numbers, as you said, it's most of the time the numbers is positive. It's very rare that it's negative. And that means if you are short in Bitcoin, you are actually receiving some form of interest rates. And we launched a product called USDP, P for perpetuals, which is a synthetic stablecoin built on top of this, which could earn you then interest rates for being stable in US dollar terms. And that's how we joined the second Legend of Lightning tournament last year, where we connected that to a Lightning network. And then you had a hot wallet where you were stable in US dollar terms. And this was basically a short position in Bitcoin. And there's no token, no issuer. And you could send it around on the Lightning network in sats. And that's just pretty cool because...
And so I couldn't see that in the 10-10-1 app. Is that in a separate app or what happened there?
We did a technology pivot again.
Okay, so you had that, but now you've had to take that away. Okay.
Yeah, we removed Lightning because we had quite some problems with random force closures and high transaction fees. And we reduced the whole complexity to the vanilla DLC channels.
DLC channel concept, as opposed to the Lightning DLC idea.
And we will re-add that in the future in a different way so that you can then send it again over Lightning.
Yeah. And so I guess just on that, was that mainly due to, the fee spikes of last year with all the ordinal stuff, and that was causing forced closures, or was there some other technical reason related to Lightning that you had to sort of de-risk it there and take that off?
Both. So from a protocol level, what we had was actually 6 or 7 transactions you had to keep off-chain around. Now, you'd only have to pay if you have to go on-chain, right? But if the fees are really, really high, let's say 200 sats per VByte or something, then this really stacks up, and a trade for $10, which people do on Lightning, they just want to trade small amounts, it's just not feasible anymore because you suddenly have to pay $50 transaction fees. I mean, you don't pay for it, but you have to reserve it in the transactions. So we said, okay, this doesn't make sense. This is getting too expensive. Also, if you have to go on-chain, it doesn't make sense because now you have a CET with a $10 output pending somewhere, and it's just not worth it to get the money out.
Back to the show in a moment. This show is brought to you by nomadcapitalist.com. Nomad Capitalist can help you with strategizing in terms of offshore, citizenship, residency, tax planning, overseas investing, and a range of these things. Now, as many of you know, I left Australia because I thought, well, for one part, the taxes were just really high, but also it was a freedom aspect for me. But you could have different reasons as to where you are going and why you were leaving as well. And so, as many of you know, I'm in Dubai in the UAE, but Dubai is not necessarily it's not necessarily for everybody. You have to figure out what's really right for you, for your family, and for your business. And so Nomad Capitalist can help you in terms of strategizing to pull together the pieces for you, because you might be looking to purchase a citizenship by investment, or you may be looking to move somewhere and get residence rights, or you may be able to get citizenship or residence rights through your heritage, through your descendancy. And so there's different aspects to consider, and Nomad Capitalists are experts in this. They are leaders. They've been doing this for over 10 years now, and they've helped people over dozens of countries in terms of getting residence rights, in terms of helping people get a citizenship permit, and also strategizing. So if you're interested in this, go to nomadcapitalist.com/apply. They are not necessarily the cheapest in this world, but they will help you in terms of strategizing. And for people with a net worth above $1 million, they'll generally make it worth your while from a financial ROI perspective, or potentially from a personal ROI perspective. Maybe that would be worth it for you. I think nomadcapitalist.com is a great service, and you can go and check them out at the link in description. This show also brought to you by CoinKite. CoinKite is the leader in Bitcoin security hardware. I use the Cold Card myself in various setups of my own. The Cold Card is a really great device. It's reliable. It's ultra secure. It has so many features. It is very versatile. And the important thing with Bitcoin private keys is you want to generate them offline and interact as much offline as you can. So the cool thing with the Cold Card is it doesn't have to phone home in order to set up a new wallet offline. And so that's the really cool part with the Cold Card. And they've got the new device coming soon, which is the Cold Card Q. I've got my pre-orders in for the Q device, but they have a range of devices, whether you're looking at the top end for the Cold Card Q or the Cold Card device, or you're looking for something a little cheaper, the Tap Signer might be an option for you. You could also look at the metal backup seed products they have, like the Seed Plate. The Seed Plate can help you back up your private keys in a way that gives you some extra peace of mind in case your hardware device fails. If we're talking 10, 20, 30 years down the line, this is something that could matter to you. So to get your Cold Card and your Bitcoin security gear, go to coinkite.com, use code Livera for a discount there. And now, back to the show with Philipp. Yeah, it's like an uneconomical output, basically, given the high fees. And so I guess, and this is going to be maybe a criticism or another angle that people might be thinking is, hey, is it really even feasible to do these things at small amounts? Like, maybe this is something that realistically, like, if we think fees are going to rise over time, and I'd be open to arguments on whether they are going to fall in Satoshi terms, but in real purchasing power terms, they're going to rise. I think it's clear. I think most people accept that idea. And so if that's the context, then this product and this app and all these things are really only going to work for people who are, let's say, richer, right? Like, you kind of need to be dealing with larger amounts to kind of be able to say, I can handle that on-chain fee risk, right? Or what do you think?
Yeah, no, totally. Unless something changes, unless we get a different soft fork, If we are stuck with what we have today, then this trading will be more for high value trades. $10 trades, it's just not economic feasible.
Right? Yeah.
I mean, same for UTXOs, right? You don't want to have a $10 or a 10,000 sats UTXO sitting around. Might not be worth it in the future to spend again.
Because, I mean, when you're talking about UTXO sizes nowadays, I think it's fair to say, like, in terms of long-term UTXOs, I would say the lower threshold is probably 1 million sats, right? Like, realistically, you want to have bigger than that just in case fees are rising, so that way you don't end up in this situation where you have uneconomical UTXOs, or at least very high fees. So, someone might be in a situation where they have $200 worth of Bitcoin in a UTXO, but they're paying like $50 in a fee. And that's not going to be, that's not going to be a nice experience for people. So, I mean, maybe that means longer term people have to be dealing with larger values here. Maybe it needs to be like 5 million sats in a trade or something like that before they are realistically able to kind of stomach the on-chain fee risk.
We actually we solved this problem very, very smoothly. But like Lucas from my team had a really cool idea. So in a DLC, usually what you do is, as you said, for each possible outcome, we have a CET. And so if you do a $1 trade, and let's say, price stays the same as it is, you get 50% and I get 50%. So that would be a 50-cent outcome. What we do is we say, okay, the minimum channel size is 250k sats. Now you still are able to do a $1 trade, but we add the remaining of the amount just to your output. So if we do the $1 trade, you get your 250k sats back plus 50 cents worth of Bitcoin on top of this. And that gets rid of the very small amounts. Now, if you still have those edge cases where you go all in and then at some point you basically win almost everything and we have like a little bit left. That might then be dust value, but everything in between, you can trade all kinds of amounts.
So with that then, does that create limitations on the way the user can trade? Because obviously they're trying to do this, you're trying to structure this in a non-custodial way, but does that mean like like you were saying, funny things will happen at very extreme valuations, right? Like if there's a big price rise or a big price drop, how big does it have to be for, edge cases to happen here?
I think right now our corners are like 100k, but since we renew the CETs every Sunday or on the rollover weekend, we can actually adjust this point every weekend. But if in between the price would jump too far, it would mean that one party would lose everything, and basically it's a liquidation price, right? Gotcha. And if you are leveraged, you would lose your money way before that anyways. I
see, yeah. Well, interesting. I guess here I'm thinking of Samson Mal's Omega candle, where he's talking about this, $100,000 candle in one day. People say God candle is 10K in one day. And so I guess if an Omega candle happens, you better be hoping you're long.
Always.
Yeah. So then how do the, on the market maker side, I presume they have some connections in with the likes of, Bitfinex and BitMEX and so on. And then that's how they're kind of having the other side of the trade for your 10-10-1 customers.
It totally depends on them. So we are aware of one market maker who just really makes a price depending on how they feel like. But they don't offer price 24/7. And then the easiest approach is they hedge their position and just add a margin.
Oh, I see. Right. And they use that to sort of keep their position neutral. Interesting. Okay. And then in terms of sizes, so we're talking a little bit about Bitcoin, like trade sizing and channel sizing here. If we're thinking about on-chain fees, and okay, as we speak today, it's actually relatively low. It's maybe like $2 or $3 to hit the chain, but we all know that the fees could spike again, and it could be $10, $20, $30 to hit the chain. So is there like a recommended minimum size? I mean, you said 250,000 sats. So is that basically just that's the minimum you would operate with, and then people can go, how high can they go?
I think so. We have a limit right now because we are technically still in beta, and I think the limit is at around 3 million sats or something.
Gotcha.
Same for our amount. So we also put up some amount in there, and the minimum amount is 250k sats, exactly because of the transaction fees.
I see. Interesting. Okay. And so do you see that in the longer term that you're going to start raising that limit? So then, let's say, maybe not whales can come to play, but let's say medium-sized traders can sort of play on the app. Is that what your goal is?
Exactly. So for the retail users in the app, we're going to keep an upper bound forever because, there's some level there, but we have a separate line of products, which we call DLC Connect. And that is targeted more for the bigger traders, the institutional traders. And there is no limit. And if we are not in this position anymore to always have the channel open to the other party because it's just too big. Let's say they want to trade 100 Bitcoin. We cannot just keep that channel open to the other trader and to the market maker. That would just be too much Bitcoin for us. Then we connect the two traders with each other, and then they open up a channel with each other, and then they can trade directly. So for the big people, there should not be a limit depending on what they want to trade. But for the retail users, they get a limit. Yeah.
That also raises, and this also was a question I had for the Atomic Finance guys, which is around hot wallets, right? Because if you have serious amount of coin, you might also have a concern about keeping a lot of money on a phone hot wallet. Do you have any thoughts around that? Do you think that's just something that, the user will just have to get comfortable with, or is there something that can be done to improve the security there?
Yeah, no, I totally agree. I mean, having a certain amount of your phone is questionable. Like all the Lightning wallets, you just want to keep it as a spending wallet. You're not going to put your millions dollars trades into that thing. So for that kind, we again think of the DLC Connect solution, which is a desktop application. And we're currently also working on bringing that to the browser, thanks to the Mutiny guys paving the way there. The idea there is that the user can plug in the hardware wallets actually, and then sign the transactions with the hardware wallet. Now, for the CETs, that would be a really pain in the ass.
Time-consuming process, right? Because you're signing like hundreds or thousands of CETs, and some of these hardware wallets are like maybe not fast, but maybe some of the newer ones are a bit faster.
Yeah, I'm not sure if they have batch signing. I'm not sure if that is a thing for hardware wallets, but the simple solution is that for the CETs, we use ephemeral keys, which are one-time keys. We only keep them around for the time of generating those CETs, and then the outputs of the CETs again go into your hardware wallet. So you basically have to fund the channel once, then you sign the you generate ephemeral keys for the CETs, sign it again with your hardware wallet, and you get all of those transactions.
Oh, I see. So you're trying to get an efficiency there on the signing. Okay. So I guess some of the stuff we've been talking about is kind of like going long, going short. Are there non-degen uses for 10.10.1? Like, basically, are there non-degen uses?
Yeah, totally. Like the USDP part is a hedging use case, and I'm super pumped about that because on a company level, this allows you to be stable in US dollar terms without having to rely on a bank account or anything. And some employees, even if they are in the Bitcoin space, they want to have a certain US dollar amount as a salary. And as a company, it would be just too risky to have everything in Bitcoin. So as a company, you can then basically hedge a certain amount of your assets into USD, be on Bitcoin, send Bitcoin around, but you are stable in US dollars. And then I can pay my employees over Lightning in Bitcoins, but fixed in US dollar terms. That's a real cool use case. And we have one company who is looking to hedge bigger amounts exactly for that reason.
Yeah, that's interesting. As you said, the USDP stable channel case, I guess. So to be clear, this, again, because of the on-chain fees, it sort of makes more sense for bigger players or business level size, right? Because if you're just trying to do this with like $10, $20, you're going to get eaten away by on-chain fees. But if we're talking like thousands of dollars, millions of sats or higher, or, proper sizes of a coin, now it starts to make more sense because now the on-chain fee is small relative to how much you're keeping stable. And then at the same time, depending on, that funding rate we were talking about, is there, they might earn something out of that too, right? A small amount?
Yeah, exactly. They are earning interest on top of that.
Right. So that could be really interesting then for like a B2B use case here, because the business could have a small, they could have like their broader kind of Bitcoin stack that's held in cold storage. Maybe they'd keep a smaller amount in this stable channel concept. And so they're getting a little bit of Bitcoin return, but keeping the rest in USD stable value to pay out for staff, right? Because there may be staff that they need to pay out. So then that would be in the concept where you're bringing back the Lightning Channel DLC, right?
Exactly. Yes. Yeah.
Right.
Yeah.
So that's kind of like the future.
Sorry, you could still do it on chain, right? For bigger amounts. If my employee gets 5,000-10,000, whatever, every month, it still makes sense to do this as an on-chain transaction. And in this case, they could then again go into the stable channel with us and be stable in US dollar terms. But we have a crazy idea is we could offer an US dollar or euro terms interest products to normies out there. Because if you look at the funding rates on perpetuals, they are actually crazy high over the year. Like they speak about 10 to 15%. Where do you get 10 to 15% interest rates in the normie world today?
But hang on, is that during like bull cycles, or you're saying just like even in non-bull cycle years?
On average, I think it's around between 5 and 15 probably. But
I see. So I presume, you correct me if I'm wrong, but my presumption would be like that 15% would be like in a crazy bull year when so many people want to go long, so they're paying a lot for that, privilege, let's say. And so because of that, they're having to pay a very high funding rate on those centralized exchanges. And in some sense, the market makers are sort of helping you facilitate some of that for your own customers on the stable channel product. Is that right?
Yeah, exactly. Yeah. And then we could build on top of this, we could build a Bitcoin bank, which offers really banking features to normal users. And they put in USD in fiat terms in there. We basically buy Bitcoin with the fiat. They are stable in the US dollar terms and earned high interest amounts compared to any other thing, any other bank or bonds or whatever.
I see. Yeah. So it kind of is harkening back to more like I guess it's maybe like wildcat banking kind of thing. But I guess some people will obviously be skeptical of that and be like, hang on, can you really offer 10, 15%? I guess the main risk here is there's custodial risk. There's a technical kind of, execution. Like you got to make sure, you have to trust that, the contract execution stuff is done correctly. You have to trust that the Oracle is, correctly attesting to the price as well. So I guess it's not like it's a risk-free thing, but there could be an interest rate. That could be offered, right?
Nothing is risk-free, right? I mean, we in the Bitcoin world know that, and there is no such thing as a free lunch neither. You can't have 15% without anything.
Some risk somewhere, yeah. You got to be taking something somewhere.
Yeah. So as you said, there's obviously technology risk, which we hope to get rid of, but there is a risk of the price fluctuation, nevertheless. And that is, you could get liquidated or your counterparty could get liquidated. Now, if you are short Bitcoin and you have a leverage of 1, if the price keeps moving up, you never get liquidated. Basically, there's no liquidation price. But if the price goes down and your counterparty has a leverage of 2, then if the price drops by over 50%, you are...
right, he gets wrecked and then you might be out. He gets wrecked.
Yeah, and then the total amount in the contract is not worth the amount in US dollars anymore.
I see, because you would get the full amount of the Bitcoin for that contract, but you might still be out per se on what you thought you were going to get, basically. Yeah, interesting.
Yeah, so we could do a napkin math example if you want. So let's say the price is at 50K right now, and we go 1 Bitcoin, so 50K short. We put in 1 Bitcoin, I put in 1 Bitcoin, you put in 1 Bitcoin. Price drops to 25K. Now there are 2 Bitcoins in there, but you went 50K short. So the 2 Bitcoins are currently worth 50K. If the price goes further
below
to
25K, then I'm losing out on the Bitcoin. And then I thought I was going to be stable in USD terms, but I'm actually not. And I've sort of lost out in that way. Yeah, interesting.
And that always happens when you don't expect it to happen, and you get those flash crashes, and the so-called stable coin is not stable at all after all.
Yeah, right. So that could be maybe just a insurmountable risk here that And, it doesn't happen all the time, but I've been in Bitcoin long enough to have been through multiple 80% drawdowns, and I've seen that happen. I guess it's not that it would just go 80% drop in one day, but it might be over the course of, a few months. So if it were to happen in a sort of a slower thing, is there anything that could be done at that point? Or is it more, or is it just sort of like you're just SOL at that point?
Nah, totally. So we have an early margin call. So we don't just let the price go down and say, hey, sorry, you got liquidated, you lost everything. We say, hey, you're in the risk of getting liquidated soon.
Right,
Maybe
so load more collateral in.
Put some more Bitcoin in, or in the worst case, we actually liquidate them before they actually get liquidated. So let's say, again, leverage of 1, price could drop to 50%, but we say by 25%, say, hey, sorry, it is getting too risky already. We're going to sell your position at the market for a better price. Someone else is going to take that and then is taking over the risk with more capital.
Yeah, that's interesting. And this is something I've seen traders talk about as well, because when they're looking at an exchange, to some extent, they're looking at the technology team, the IT team of that exchange, and how good they are at deleveraging and like automating and having that engine work correctly. Because if it doesn't, that's where these kinds of scenarios can happen and someone gets wrecked, or many people get wrecked. And if the exchange doesn't deal with that correctly, you're SOL, you're out of luck at that point. So yeah, interesting. But then I guess, do you think that would represent a showstopper then? Because like at the B2B customer level, they might be sort of like, oh, I'm a bit worried that, your liquidation engine won't work correctly, or not liquidation engine in this case. In your case, it's more like the CETs don't sort of work correctly, or that it doesn't happen fast enough for them to sort of get their money back.
Yeah, I mean, it is a risk, and we have to build up a certain reputation to really get those big traders in. So we are building slowly this up. People can trust the technology, can trust us. And yeah, I mean, it's like everything in the world. Don't just put in your life savings. Trade with smaller amounts until you get comfortable with it.
Yeah, so I guess that those are probably, that's going to be probably some of the main hang-ups. So yeah, so the security aspect of it, but you said that I guess there's a hardware wallet or desktop component of that. Also, I know a lot of the DLC guys are interested in CTV, check template verify. So do you want to just explain a bit of your thoughts on that? Whether you would like to see CTV, what implications that would have for DLC products? Yeah,
actually, before we were building Ichi-sats on Bitcoin, we were building something on Liquid where we already have some more powerful opcodes, and we could build covenant scripts which were enforcing certain things on chain already. And
right,
that
because that's like the introspection aspect.
Exactly, yes.
Yeah.
And there is a product called Fuji Money. I'm not sure if
I know the guys.
Yeah. So they picked up that idea exactly, where you use collateralized lending, and it is, I wouldn't call it a DLC, but it uses the same kind of concept where they have an oracle which attests to the price. And then depending on the price, you have to put in a certain amount and pay back a certain amount, and then you get back your money. And with CTV, we can build something similar like that, or more powerful DLCs on-chain, which then removes or reduces the on-chain footprint, which reduces potentially the need to recreate CETs on every week. So there's so much we can do with more powerful opcodes.
Back to the show in a moment. The lead sponsor of this show is Swan Bitcoin, and as many of you know, I work at Swan. I'm head of education there. So over at Swan, you can buy Bitcoin and you can learn about Bitcoin. You can send your fiat in using ACH if you're in the US, or you can send in your dirty fiat using an international wire if you're overseas, or of course you can send a wire locally also in the United States. Now Swan makes it easy for you to buy Bitcoin. You can either do what's called a smash buy, just take a lump sum, or you can set up an automated Bitcoin savings plan, or think of it like an automated recurring purchase. This is something that is useful for dealing with the volatility of Bitcoin. As many of you know, Bitcoin can be quite volatile, and just regularly accumulating some can be a great way to just accumulate over time and not really worry so much about the volatility. Over at Swan, there are a range of educational resources available, such as Swan Signal, and my colleague Dante Cook has a great daily show that he's putting out. There's just so much material that you can find. Sign up for the newsletter. You can find a range of material over at swan.com/Livera. And lastly, this show is brought to you by Mempool.space. Mempool.space is the leading Bitcoin and blockchain visualizer. I use it all the time because I want to keep an eye on where Bitcoin's mempool is at and what kind of fee I need to attach to a transaction to get that transaction confirmed into the next block, if that's what I'm looking for. Of course, set this according to your own time preference. If you are more patient for that particular transaction, you can set the fee a bit lower, but I like to check Mempool.space so that way I can set my fee somewhere that's in the appropriate range. Look, I think Mempool.space make a range of innovative visualizations and tools that you can use to interact with the Bitcoin economy, whether that's their mempool goggles, whether that's the RBF history, whether that's the ability to look at the Mining Explorer, the Lightning Explorer, the Liquid Explorer. You can search transactions. There's so much you can do there over at mempool.space. And don't forget, they've got an accelerator. So if you want to sign up for the transaction accelerator coming up, that's mempool.space/accelerator. And now back to the show with Philip. Yeah, interesting to see. And then I guess for some people, they might be interested to talk about a comparison of some of the different stable coin or stable channel concepts, right? So you could either, I guess, on one side you got fully, statist, regulated, KYC banking, using a US dollar bank account. That's one, obviously, that's one thing. Not everybody can access that. That's certain risks there. There's Tether, right? And people have Tether on Liquid and ERC20 Tether and TRC20 Tether and this kind of thing. And that's more, you're using, let's say, Liquid or Ethereum or Tron or whatever chain to really move the stablecoins around, but you're ultimately trusting Tether and the bank accounts that they hold their dollars in, basically. And you're kind of trusting that, Tether doesn't get rugged in themselves as well at the government level, maybe. Then I guess on the other side, you've got maybe, I'm thinking of Blink. So Blink from Galloy, right? They've got this concept of stable sats, and that's kind of like they're centrally managing it for their end users. That's maybe another way to sort of have a quote unquote stable value, and it is again custodial. And then this DLC style. So this DLC style, I guess maybe the main you could argue it has certain elements of more self-custodialism because it is in Bitcoin terms, but maybe the downside would be, you might have to hit the chain, which means on-chain fees, and maybe a little more tech. You're dealing with the Oracle as well. You have to deal with is the Oracle correct? So I'm curious, as I sort of lay out the options there, what do you think? Do you agree, disagree, or do you have anything you want to sort of elaborate there on this idea of having stable value but using Bitcoin and Bitcoin adjacent technology?
Yeah, no, what you said was beautiful description of the different spectrum of stable coins. And in fiat, you pick your poison, right? If you want to be fully in the fiat world, use a bank account. If you want to be in the crypto world, but fully always or as closely packed as possible, use a stable coin like Tether or USDC. If you trust Blink because you're already banking, Bitcoin banking with them, you can trust Blink. But if you don't want to trust anyone and you want to think of this risk of, hey, what if Tether is not there tomorrow anymore? Then all the tethers around are just nothing worth anymore. And with the zero counterparty risk approach of using DLCs, if we disappear, at the end of the day, you still have your sats. And it's sats, if you believe in Bitcoin, is always worth something.
Yeah, that's an interesting point, as you said. So it's kind of that self-custodial nature. There are downsides and trade-offs to that, right? You said, like we said, like on-chain fees, but what you get for that trade-off is that you can get your money back, even if the counterparty goes down. So I think that's probably the key differentiator, it seems. So when it comes to this concept of stable channels and ideally having it in a Lightning stable channel, do you see more adoption of that idea coming, or is it sort of like an idea that people have been talking about this for years and years, but it doesn't seem to have really come to very much fruition yet? I'm curious why you think that is.
Yeah, it is. It's an interesting topic. I used to be really, really bullish on this approach of having a stable coin on Lightning, But from a financial perspective, I think the amounts there are just way too small. And if you compare it to traders, they usually trade 100 or thousands or whatever amount. They don't want to transact in $1 worth of stablecoin. But if you have a hot wallet, you want to pay for your coffee, and your coffee is worth $3 or whatever. So you send around $3 worth of sats in this more complicated technology. And I mean, it's still super fast, but you still have to generate a few thousand transactions and collaboratively sign this. And it is an overhead. I think it has an advantage because it is censorship resistant. It has no token, no issue, no other blockchain. But I'm not that bullish on this use case for end user product. If you think of the big players, again, like
a business
companies,
doing staff payroll payouts. Yeah,
exactly. Then again, I think it makes more sense because you have big amounts, you hold it for a longer time period. It just makes more sense.
Yeah, I see. Or even just B2B payments, right? If both sides actually are comfortable with doing Lightning payments, but they want some USD stability. You know, I've heard of cases where, you know, people in like Africa are paying their suppliers in China with Bitcoin, right? Again, that could be another example where if both sides of that transaction want some USD stability, then maybe that's a case there. One other area, I guess I forgot to mention this, is like the RGB and Taro, or formerly Taro, now called Taproot assets. Where would you sort of put that into would you say that just kind of in the same sort of Tether stablecoin category, or where would you put that?
It might be a complete mix, right? I mean, Tether could easily issue tokens on RGB or Taproot assets, but you might also be able to build something like DAI on Ethereum, or Fuji Money on Liquid, where you collateralize your loan, you get a stablecoin for putting in Bitcoin, which is basically nothing else as a trade. You go leverage long or short on on Bitcoin in this case. And the difference though is that you get an actual token, and it might be fungible, it might be non-fungible. And this token then can be sent around with Taproot assets on the Lightning Network.
Yeah, interesting. And so that could also get interesting because with Taproot assets, obviously it's by the Lightning Labs team. They're making LND, which is obviously one of the leading Lightning implementations. So it might be sort of very easy to get support for that across the network, let's say, to, you know, now I understand there's a lot of technical details that go into this, but my understanding is with the Taproot assets, the idea is they want to make it so that they can just present a Lightning QR to users, and the user doesn't really know whether they're dealing, you know, they're just paying a Lightning invoice as far as they're concerned. It's that many sats paid in the invoice. So there may be opportunities there for like interaction, like maybe somebody wants to be a Taproot assets like swap server, and maybe they want to connect with your market maker, or, you know, somebody else who's got a Lightning DLC channel, and maybe they can sort of interact using Lightning as their layer to interact.
Yeah, totally. Like I think there is a need for actual tokens, because a token can be held differently than a DLC. Because for the DLC, if I want to be stable in US dollars again and hold the synthetic stablecoin, I have to remember all those contracts, all the CETs. But if you have a token, then you don't have to keep so much information around. You just have one UTXO output and you can send this around. So the way how to combine those two worlds is exactly as you said. In the most simplistic, naive approach, you take a trusted setup where one party goes short and is stable in US dollar terms, and then issues tokens on RGB or Taproot assets, and then hands this out to other users. You can then buy it or trade it or whatever. And then these Taproot assets can then be sent around over Lightning or even on-chain. Right now, they're more on-chain, right?
One other question. So with 10.10.1 as it is now, as I'm sure you're familiar, you're thinking about this also, is that if the user has to sort of switch around between lots of different apps, they end up kind of having to move, you know, money from left pocket into the right pocket, but each time they're paying on-chain fees. So I'm curious if you have any thoughts on what the future of these apps looks like. Is it going to be more like kind of one app to sort of deal with a bunch of things, to kind of have your Lightning stuff and your DLC stuff? Or what are you thinking there?
That is a good question. I never thought about this being a big problem because, I mean, I have like 7 different Lightning wallets on my phone probably.
I mean, many of us, like people like you and me and listeners of, this show probably are in that situation. But let's say a more normie person might be like, I just want one app that just does everything, maybe that's where for them, they might look at apps that kind of do one thing, do everything for one, all their Bitcoin and stablecoin stuff all in one.
And that was exactly our initial vision of Bitcoin. Our slogan was one app, all things Bitcoin. And the idea was you have a combination of different wallets in there, from your on-chain wallet to your Lightning wallet to your stable sats wallet to your trading wallet. And you can seamlessly transact in between for a certain fee. At some point we said, okay, we show a unified amount. So we don't even split the amounts where you have it on chain or not. We just say, okay, you can, like Moon, you can transact wherever. And then the app decides whether you do a Lightning payment or you do an on-chain payment.
Yeah, I see.
I think we're going to pick that idea up more in the future. Right now, we reduced all of the overhead towards a simple trading wallet.
I see. Yeah. And part of that is, as you mentioned, the technical complexity, right? Because it sounds great to have it all, but there's actually a lot of technical complexity under the hood to achieve that. And so I think that's probably the reality of it. And so I guess let's zoom out a bit. We've kind of been in the, technical and sort of details, but if we zoom out a little bit, would you say the reason we haven't seen this explosion of non-custodial, finance on Bitcoin is because centralized custodian apps and platforms and websites are just easier, more convenient, or is there some other reason?
Yeah, I think that's one big part. UX, UI, it is way harder to build good UX in a self-custodial way than having a fancy UI on top of an SQL database. So it's way harder to achieve the same level of UX, but also on the educational level. People don't realize it yet that they actually need it. And there are a few service providers out there who are not really transparent on the risk model. It looks like you're actually transacting on Lightning and you're trading on Lightning, but it is still a fully custodial approach. And those users then ask us, hey, why should I trade with 1010 and not with this provider? And the simple answer we say is, do you have a seed phrase? Can you get your money out? And then they suddenly start thinking, oh yeah, okay, this is fully custodial. So it's on the educational level that most people don't actually realize that there is such a high risk involved in the tools they're using. But it's also on the UX. It's just way harder to build good tools. Yeah,
I'm reminded here of, this is actually a book Peter McCormack mentions on his show sometimes. It says, don't make me think, right? And it's like this idea of, obviously listeners of this podcast are not sort of the audience, let's say, right? Because it's a smaller group of people who are, let's say, intellectually interested about Bitcoin and technical things and economic things. But what people are building is sort of apps for the people who don't really want to get into the detail of that. Because, and in fairness, maybe it's because they've got a family, they've got other hobbies, they have other, they don't want to make Bitcoin and Bitcoin their life, and so for that reason, maybe that UX hurdle is just a hard one.
Yeah, self-custodial is like an insurance, right? You only need that when you actually need it, and we are in a normal world where people start thinking of having an insurance for your car before problems happen. But in the Bitcoin space, we are not there yet. Not everyone is thinking about this, and most traders who are coming to us are actually those who got burned in the past, and then they learned their lessons. They have been trading on FTX and lost some money there. They've been trading on Mt. Gox and lost some money there. And usually it doesn't happen twice to them. So I really don't hope it's going to happen to everyone, but I think we will see those kind of exchanges going down again in the future. Might not because of fraud, but maybe because of governments shutting down the exchange, and then you just can't get your money out. Or like maybe a wallet provider just says, okay, sorry, we're not going to serve customers in your country anymore because of regulations. And you're like, wait a minute, I still have money on your wallet. And that's then when you realize, hey, actually self-custodial is not that bad. Maybe I should look into that again.
Yeah, I see. So yeah, it just comes down to what price are people willing to pay, because it's one of those things where, sometimes people will say they want something, but they're not willing to pay the price for it. And that's kind of the difference between what somebody will say and what they'll actually do when it, comes time to do things. But nevertheless, it's an interesting area. Any closing thoughts on, the future of DLCs, self-custodial finance?
Yeah, I think we're just getting started. I mean, you can try out 10.10.1 today already. We have the public beta on Android, iOS, and you can also download an APK. But there is so much more to come, and there are some really exciting approaches to make this way more efficient, way better, reduce the on-chain footprint, and remove UX. But just follow us, and you will learn about this.
Great. Okay, well, thanks for joining me, Philip.
Thanks for having me, Stephan.
I hope you enjoyed the show. Get the show notes at stephanlivera.com. Subscribe to the newsletter at stephanlivera.substack.com, and I will see you in the Citadels.